So if you decided to invest in the stock market, but how do you go about picking the right stocks? Yes, I have an intro now, so let me know what you think. I'm not sure whether I'm going to keep it or not, but yeah, please let me know your thoughts in the comments. So anyway, it's never been cheaper or easier to buy stocks and shares. However, just because it's cheap and easy doesn't mean you'll make the right decisions when you're buying them. But the only reason you're investing in the stock market is to try and make money. So if you're a beginner, how do you even go about picking a stock that might be a winner in the long term? In reality, a lot of professional fund managers fail to beat the market. And for most people, it would probably be better for them to put their money in an index fund that tracks something like the S&P 500 or an all-world index or the FTSE 100, something like that. And I personally have about 50% of my investments in those ETF funds. I'm not going to get into ETFs in this video. I do have another video about ETFs. If you want to know about it, I'll leave a link in the description below. But if you have a high risk mentality or are trying to build a particular type of portfolio, which means you want to pick your own stocks, then you're going to want to know at least a few ways of identifying which stocks might be a good buy and which might not be such a good buy. Now, before we start this, I am by no means a financial guru. I am new to the stock market myself, and this is just things that I've picked up in the 3 months or so that I've been investing, that I have been using to pick stocks. Now, I've done a fair bit of research and these seem to be some decent basics on which you then can expand on, but if you are a beginner, this should be a good starting point. Now, this is by no means an exhaustive list, but unless you're a professional investor or have a lot of time on your hands to do a decent amount of research, then there's only so much time you can spend looking at different stocks before you're going to pick one. That being said, my point one is, do you know what the company does? Just because a company is called 5G, blockchain, Elon Musk, Jeff Bezos, and is recommended on Motley Fool isn't really enough. But how do you go about finding out about a company and what it does? Well, first off, I would go to your broker. I use the Trading 212 app. And when you're on that, when you click onto the stock, one of the first things you'll see is a company description. Now that will give you a very brief overview of what the company does, and it'll allow you to understand whether it's something you want to be invested in or potentially not. Now, again, that's only a very brief description. For instance, if we were to look at a recent stock that I've bought, which is Bellway, we'll be able to see that it's a construction company that builds properties and where it's based and the different regions that it builds properties in. Again, that probably isn't enough on its own. What I would recommend you do after that is, once you've interested in that company and get a better understanding of it, is go and research its annual report. Now, they're really easy to find. All you have to do is Google, let's say, Bellway annual report, and we can then go and read the 2019 annual report. I know I've said annual report a lot. Now, again, these can be 30, 40, 50 pages long, but you don't have to read the whole thing. There's going to be a few areas where you can skim read a lot of different annual reports quite quickly. One, you can look at the director's or chief executive summary, and I like to focus on any areas where they're talking about growth, because that's really what you're looking for when you're buying a company. Where is it going to grow? What market is it going to grow into? What's its strategy? I know a lot of people aren't going to go and read an annual report, but if you can't spend 30 minutes flicking through for keywords within an annual report and read the summary, then you probably shouldn't be investing in that stock. Just put your money into an ETF and be done with it. That's not to say you might not get lucky and buy Tesla stock 3 months ago and be sitting on a couple of 100% profit, but you're not going to be able to repeat that time and time again. Point two is the price to earnings ratio, and that's often shown as the P/E ratio. Now, if we were to scroll down on the Trading 212 app, we would see that Bellway's price to earnings ratio is currently just over 6. And that means, because I bought that stock, I'm willing to pay £6 for every £1 the company earned in the last 12 months. And the price to earnings ratio is pretty easy to calculate, and it's a good idea to know how it's calculated when you're using these kind of things. So all you have to do is take the current Bellway stock price, which is about £26, and then divide that by the earnings per share, which is just over £4. Earnings per share just being the amount of profit that company made divided by the number of shares they have. You know, it pretty much does what it says on the tin. Okay, so now you know what the price to earnings ratio is. How do you use that when trying to pick a stock? Well, it allows you to compare different similar type stocks together and see if one might be more or less valued than the other one. Just sticking with Bellway, if we were to have a look at a similar competitor, so another house builder, let's just say Persimmon, and we were to have a look at what its current P to E ratio was, we can see that it's trading just over 9. So we can see by comparing Persimmon against Bellway that Bellway is currently cheaper than the Persimmon stock. So if everything else was equal, then Bellway would be a better shout. Now there might well be a reason why Persimmon is trading higher than Bellway. Maybe it's seen to have a better growth in the future. Maybe it has something else that's causing people to think it's going to perform better. So you can't just use it on its own, but together with a few other things, it will allow you to assess different stocks of the same type. Obviously, in an ideal world, you'd find a stock that has a really low PE ratio that's got massive growth potential. And that's what value investors try to do. Now, the average PE ratio for the S&P 500 and also the FTSE 100 is about 15-16. Now, if you were to compare that to some of the tech stocks, like maybe Amazon, I believe it's got a PE of probably over 100, 130, but people obviously believe it's got that amount of room to grow. Another variant of looking at the PE ratio would be the PEG ratio, which is the price to earnings against growth. And what you could do then is say, okay, I'm looking at a stock that has a PE of 15, but it's looking like it's going to grow 15% year on year. We divide 15 by 15 and we get 1. Anything below 1 or around 1 would be a very good company to look at. If it starts getting higher and higher and higher, then maybe you don't want to be looking at that. That's getting a little bit more technical because you have to know what you think that company is going to grow by. But if you're just looking to compare companies, the price earnings ratio is a great way to do it. Point 3 is the beta. Now I have to admit, I had no idea what the beta was for about 2 months into investing. I would scroll past it on the way to looking at the earnings and the profits and all that kind of stuff and just ignore it completely. But once you get to know what it is, it's actually quite useful and it's pretty easy to understand. So all it does is look at the volatility of that particular stock, whether it's more or less volatile than the market average. So if we pick a high growth stock, let's just stick with the Amazon example, and we have a look at its beta on the Trading 212 app, we can see that it's got a beta of 1.36. So that's higher than 1. So that stock has been more volatile than the market average. As we can see, it's obviously grown a lot. Obviously, the same would be true if it's sunk a lot. So it doesn't tell you anything about if that volatility has been good or bad. So if you compare that high growth company like Amazon against, I don't know, a very stable company, just a dividend payer, not that much room to grow, but decent profits, let's say a water company, United Utilities, and we were to have a look at their beta on Trading 212, we would see that it is 0.48, so less than 1. It has been less volatile than the market. If you were looking at investing in stocks that were safe and secure, you'd probably look at those stocks that had a beta of less than 1. If you're looking for higher risk investments that might be able to get you higher growth, then you probably want to have a look at stocks that have a beta higher than 1. Point 4 is dividends. Now, most people know what dividends are pretty much. It's something that I knew about before investing in the stock market, and to be brutally honest, I did not have that much idea about the stock market before I started investing. And I do have a video that goes into a few more of the details around investing in dividends, but in short, a dividend is pretty much just a thank you from a company for investing in it. Now, a lot of people build their portfolios around dividend paying stocks so that can pay them an income. Now, either you can invest that back into your stocks, which is reinvesting, or you can take that as an income and go and spend it on whatever you want. Now, generally, if you're building a portfolio, you will reinvest those dividends. And then when you come to a point where you want to take an income or retire, then you'll get paid those dividends once your pot is big enough. The best dividends are generally paid by larger, more established companies that have regular profits. Some key sectors for big dividend paying companies include oil and gas, healthcare, pharmaceuticals, if you can say that word, and utilities. Now, the S&P 500 has an average dividend of about 2%, and the FTSE 100 has an average dividend of about 4 to 5%. Now, obviously, the FTSE 100 would seem to be outperforming the S&P 500 there. However, if you to have a look at both of those indexes, then the S&P 500 has far and away outperformed the FTSE 100. So dividends aren't necessarily the be-all and end-all of everything, but if you're trying to build a dividend portfolio to get yourself some secure and long-term income in the future, then these are the type of things you want to have a look at. And lastly, number 5 is charts. Now, I'm not saying you have to pore over graphs of candlesticks hour over hour, but being able to have a look at a chart to see whether the stock has grown or shrunk is definitely a good thing. So if you were to go onto the Trading 2-1 platform, pretty much the first thing you'll see when you click onto the stock is the chart. Now you can go to max to see it over the decent time period. It's normally up to about 2013, 2012. Again, if we just go back to Bellway, we can see that that has been growing over those years, pretty much all of that time anyway. Now, if we were to have a look at something else, maybe General Electric, and we were to have a look at it over the same time period, we can see since about 2017 that that stock has been decreasing. Now, I'm not saying that stock isn't a buy. I haven't looked into it myself, but when looking at that, that's a bit of a question mark over that stock. If it is going downwards rather than upwards, is it a good investment? Quite possibly not. Then if you were to scroll down further on the Trading 212 app, and I'm sure other brokers also have this kind of information as well, if we were to scroll down further, we would see things like revenues and profits. Again, we want to see those increasing ideally year on year. One thing to be a little bit wary about when looking at things like revenues and profits is don't get so caught up in the fact that the company's revenues are increasing if their profits aren't, as revenue without profit is pretty much pointless. Now, if you're a long-term buy and hold investor, you don't necessarily have to get into some of the nitty-gritty detail looking at different stochastic oscillators and different charts, candlesticks on when it's best to buy a stock on a particular day, as if you kind of expand out and look at it over a 5-10 year period, those tiny increases and decreases in general, they're not going to matter. However, I know as a beginner, especially me, you want to start making profits straight away, and you want to make sure you're picking a stock at the right time during that day. Now, I know on things like free trade, when you buy a stock, it just buys it at the end of the day, and that kind of takes that stress away potentially. But if you're on a site like Trading 212 and it allows you to buy that stock then and there, there's a few things that I've been doing just to try and time the market a little bit. Now, the main thing I've been looking at when looking at stocks, and I'll show you just with example with Bellway again, is when you click into a chart, you can add things like Bollinger Bands and simple moving averages and all this kind of stuff. You could add as many different chart lines as you wanted to. The main one I've been using is the slow stochastic oscillator. Now, how you look at that is, one, there's a great guide on slow stochastic oscillators on the Trading 212 YouTube page, so you could probably go and have a look after this. Or pretty much all you need to have a look at is whether that line is coming up above the bottom line. So has it turned a corner and is coming back up, and that's potentially a buy signal. Not always, but it just gives you a bit of an idea whether the stock is currently priced low compared to what it has been recently. Again, I wouldn't get too caught up in that really if you're a long-term buy and hold investor like I am. But again, I know that when you're first investing, those kind of 1 and 2% feel like a lot. So that might just help you out and make you feel a bit better that you've bought at the right time. Okay, so there are 5 basic ways you can start to look at different stocks and investigate whether they're a buy for you or not. Now, I'm by no means saying that they're the only things you can look at. It's just a few things that I've been looking at as a beginner investor. I know that professional investors are going to say, do research, and that's obviously true, but if you don't have the time and an army of researchers do it, then you've got to try and pick things that are going to help you whittle down the list of stocks you want to buy. And as I've said in previous videos, my plan is to have 50% of my stocks in ETFs and 50% in my different stock picks, up to a maximum of about 20 individual stocks. And at the end of the year, I'm then going to reassess my position. I might decide I can't be bothered to do that amount of research that's probably needed to buy those stocks, or I'm going to put all my money into those ETFs, or I'm going to say, yeah, I want 50-50 split, or I want all high risk stocks. I don't know. We'll see what happens at the end of the year, but currently I'm going with a 50-50 split and see how that works out for me. If you found this video useful, please like and subscribe. I'm a little channel, so help me out. Also, I'd be interested to know how you personally like to pick stocks, what different things you look at when you're choosing a stock to buy. Maybe if I get enough comments of different people's ways of picking stocks, I'll do like a part 2 video of how YouTube commenters like to pick their stocks as well. If you're watching this thinking about dipping your toe in the stock market and you wanting to use the Trading2One platform like I am, then there is a link in the description below. If you sign on using that link, you will get a free stock worth up to the value of £100. So it's a nice little bonus to start your investment journey. Anyway, that's it from me. See you later.